September's non-farm payrolls surprised the market with a robust increase of 254,000 jobs, significantly outpacing the expected 140,000. This strong performance is underscored by a two-month net revision adding 72,000 jobs, a stark contrast to the previous downward revision of 86,000. The unemployment rate dipped to 4.1%, slightly better than the prior 4.2%, indicating a tightening labor market. Interestingly, the unrounded unemployment rate sits at 4.220%, reflecting subtle shifts in employment dynamics. The participation rate remained steady at 62.7%, suggesting that while more jobs are being created, the labor force is not expanding significantly. Private payrolls also showed strength, rising by 223,000, with prior figures adjusted down slightly from 118,000 to 114,000. Lastly, the U6 underemployment rate improved to 7.7% from 7.9%, hinting at a gradual easing of underemployment pressures. Overall, these numbers paint a picture of resilience in the labor market, which could have implications for economic policy and business strategy moving forward. The latest labor market data reveals some intriguing shifts. Average hourly earnings rose by 0.4%, slightly beating the 0.3% expectation, while the prior figure was revised up to 0.5%. Year-over-year, earnings are now at 4%, surpassing the anticipated 3.8%. However, average weekly hours dipped to 34.2 from 34.3, indicating a potential slowdown in work demand. Manufacturing payrolls contracted by 7,000, a significant improvement from the previous loss of 24,000. On a brighter note, the household survey showed a robust increase of 430,000 jobs, well above the prior 168,000. Government jobs also added 31,000, exceeding the previous 24,000. The standout figure is the full-time employment surge of 631,000, contrasting sharply with the prior loss of 438,000. Meanwhile, part-time jobs fell by 201,000, diverging from the previous gain of 527,000. Before this data drop, the market was pricing in a 32% chance of the Fed cutting rates by 50 basis points at the upcoming November meeting. With these mixed signals, investors and traders will need to recalibrate their expectations as we navigate this complex economic landscape. US dollar to Japanese yen was trading at 146.58 just before the latest employment numbers dropped, and the market reacted swiftly. The unemployment rate dipped close to 4%, marking the strongest headline reading since March. This data effectively buries any speculation about a 50 basis point hike, even if the October report shows some softness. The US dollar surged on this news, and it's easy to see why. There are no significant flaws in the report. US dollar to Japanese yen has shot up 160 pips, now sitting at 148.18. This strength indicates robust market confidence in the dollar, and traders should be keenly watching for any further developments. The momentum is clearly in favor of the dollar, and it's a critical time to reassess positions in this pair.
Thanks for tuning in to Global News 04, your source for all the latest news across every area. Don't forget to like, share, and subscribe to our YouTube channel. Stay tuned, and make sure to turn on all notifications to stay up to date with the latest global news. Check out our other videos for more in-depth coverage, and follow us on social media to never miss a beat. If you'd like to support our work, scan the QR code to make a contribution. See you next time.